The derivative detonation, how a $600 trillion market could end the financial world. One. The market nobody understands. There's a $600 trillion market hiding in plain sight. Bigger than global GDP, bigger than every stock, bond, and mortgage combined. It's called the derivatives market, and it's the world's most dangerous secret. Warren Buffett didn't call it risky. He called it a financial weapon of mass destruction. And when it exploded in 2008, it nearly ended modern finance. Lehman Brothers had $35 trillion in exposure. AIG owed $500 billion. The bailout? $29 trillion globally. So what does that actually mean? It means the bomb went off once, and we built a bigger one. Footnote. The derivatives market functions as an unregulated global casino where speculative leverage amplifies systemic risk beyond measurable limits. 2. What derivatives really are. A derivative isn't an investment, it's a bet. A wager on the price of something else, oil, wheat, currencies, interest rates, even other bets. You don't have to own the thing to gamble on it. It's like buying fire insurance on your neighbor's house and hoping it burns down. Except in this casino, the house, the street, and the whole city are all insured, and then reinsured. This isn't a market, it's a stack of promises so dense that nobody knows who owes whom. And that's the point. Footnote. Derivatives decouple financial exposure from underlying assets, transforming risk into a chain of opaque, mutually dependent liabilities. 3. The four giants holding the fuse. Today, 4 U.S. banks control most of the global derivative exposure. J.P. Morgan Chase, $54 trillion. Citibank, $48 trillion. Goldman Sachs, $47 trillion. Bank of America, $37 trillion. That's $186 trillion on just 4 balance sheets, nearly double the size of the world economy. They're all counterparties to each other, so if one fails, all fail. So what does that actually mean? It means the financial system is a house of mirrors where every reflection owes money to another reflection. Footnote. Concentration of derivative exposure among a handful of institutions converts local insolvency risk into global contagion potential. 4. Why it's worse than 2008. In 2008, derivatives totaled about $60 trillion. Today, they exceed $600 trillion, a tenfold increase. The system didn't reform, it scaled up. Interest rates have spiked from near zero to over 5%. That's catastrophic for the $500 trillion in rate-based derivatives. Commercial real estate is collapsing. European banks are wobbling. Sovereign debt is exploding. And each shock reverberates through this invisible web. The difference? In 2008, governments could bail it out. In 2025, they can't. Footnote. Global debt saturation, inflation constraints, and central bank fatigue eliminate the policy tools that stabilized the 2008 crisis. 5. How collapse actually spreads. It starts quietly. One bank misses a margin call. A clearinghouse issues a default notice. Instantly, every counterparty realizes they're exposed. Interbank lending freezes. Liquidity evaporates. Trade stops. Payrolls stop. ATMs stop. Within 48 hours, the entire system locks. Banks can't sell their assets because derivatives aren't assets, they're obligations. The selling spiral begins. So what does that actually mean? It means the next collapse won't take months. It'll take hours. Footnote. Derivative interconnectivity ensures contagion propagates at digital speed, overwhelming traditional liquidity and regulatory response mechanisms. 6. The end of bailouts. In 2008, $29 trillion saved a $60 trillion market. Today, Even if 10% of the system fails, that's $60 trillion in losses. There isn't enough liquidity, collateral, or political will to fill that hole. Print the money, and currencies implode. Don't print, and the banks implode. Either way, confidence dies, and when confidence dies, money dies. Footnote. The current derivative scale surpasses global fiscal capacity, rendering traditional central bank interventions mathematically insufficient. 7. The domino's already wobbling. Interest rates, commercial real estate, European banking, sovereign debt, geopolitics, each is a trigger waiting to pull the others down. A war, a bond failure, or even a single default could ignite the chain. The math is merciless: 6 times the size of the world economy, wired through instant settlement, powered by leverage, and guarded by denial. So what does that actually mean? It means the next financial crisis won't start, it'll detonate. Footnote. The derivative system's size and speed transform localized shocks into synchronized global breakdowns. 8. The reset beyond collapse. When the derivative bomb finally goes off, bailouts will fail, currencies will fracture, and trade will halt. Governments will nationalize banks. New currencies will emerge, digital, controlled, and programmable. Savings will be restructured. Pensions rewritten. The dollar may lose its throne. What rises next will not be a recovery. It will be a reset. Footnote. Systemic failure will catalyze a transition toward centralized digital monetary regimes under crisis justification. 9. The fuse is already burning. Buffett warned us in 2003. The detonation came in 2008. This time, the weapon is 10 times larger and globalized through code. The fuse? Already lit. 2025 to 2026 will test whether the world's financial system is still a market, or merely a mirage waiting to implode. So what does that actually mean? It means the system isn't too big to fail anymore. It's too big to save. Footnote. The exponential expansion of derivative exposure ensures that systemic collapse, once triggered, will exceed both fiscal capacity and temporal control,